On week, it's all about a trading principle, and we develop a strategy utilizing the footprint, sometimes the market profile, and then I show you the execution methodology, and obviously we do answer some questions that come through. Now, again, I think this follows on from what we saw 2 weeks ago, where someone said to me, what do I think of gold? Okay, now I've been asked this question twice, what do I think of gold? And I'm going to kind of flip this question and tell you what I think of DAX. Okay, I'm going to show you the understanding around the DAX. Obviously, not many of you trade the DAX for good reason. Okay, it's a relatively expensive futures product to learn to trade. And unless you've got a relatively large account size, for example, at least $100,000, there's no point in actually trading the DAX, just simply because of the kind of stops you have to use and how much you have to risk per trade. So we're going to talk a little bit about DAX today. In hope that I can kind of dispel this idea that, you can only trade certain markets. You can't, okay? At the end of the day, a trade strategy is a trade strategy. It doesn't matter the market you're applying it to. So we're going to talk a little bit about breakout trading. I'm going to put it into context for you. It is very much a contextual type strategy, and it's very much a momentum-based strategy. Now, this is what we're looking at, okay? And I probably shouldn't have told you the market for fear of almost sort of giving you somewhat of a bias. Now, if any trader looks at this is why I've got no price or indication of what this might be. If any trader were to look at this, they would call it a flag. Okay, now I never like identifying patterns as this and that, because the moment you associate a pattern with this is a flag or this is a pennant or this, that, you immediately implement some form of a sort of a bias in your understanding. In other words, if you perceive this as a flag, you'd straight away think, well, continuation. Okay, for me, rather, I prefer to look at things in terms of, what has occurred, what is occurring, and what is likely to occur. Now, what has occurred is that we've seen a very significant buying wave that started on this red line, and we got a secondary buying wave on the blue line. Hence why I've got a red line there and a blue line there. Okay, it's indicating to me this is where the buyers were very, very strong. They were initiating off of these prices. Okay, and the subsequent move is we had a very strong move from the red line to this sort of top line, and then we got a little bit of a consolidation rotation higher. Okay, we've now run into this higher end of prices, and the market's now oscillating or consolidating in a narrow range. Okay, so that's the way I see it. Now, yes, we can call that a flag, we can call it a pennant, we can call it an initiative consolidation, we can call it whatever the hell we like. Okay, the important thing is what we do with this information. Okay, this is the art of a trader, is you've got to know not just what has come, but what is likely to occur and how you can partake in that most likely event. Okay, now, as a standard practice, generally speaking, there's a set of rules when it comes to breakout trading. I'm going to take you through those. We're then going to go through the DAX, and I'm going to show you a few things you can work on, with regards to this DAX. Okay. Now, the first thing to understand and interpret, right, is I'm actually going to start with the positioning of the market. All right. So the first thing you need to interpret is what is the positioning of this market. Right. And that's the first question to answer. Well, very simply, we could see that the market net long off of the red line, right? We then added to those longs. Okay, remember, longs don't always add at higher prices. Just because prices are going high doesn't mean that people are buying it. Okay, that's important to understand. It's a very important distinction. Where those positionings base themselves, and that's where those big buyers step in, that's where the positions are. In other words, the market went long on this day, a little bit of consolidation, maybe a little bit of short stopping out on this day. We then got more longs entering the market very aggressively there. Okay, so we've got longs entering there, longs entering there. Now, to assume that obviously longs are buying is fair enough. I can understand how you'd make that assumption, but it's important to determine where that positioning starts, and that's the art form. Okay, it's not about me being right, you being wrong. It's about where do you interpret the longs as entering the market. Okay, for me the longs are positioned there, and so long as we stay above, certain prices, we should maintain the bid to the upside. Okay, so the short-term positioning is very, very, very much to the upside. Okay, and we can see that because of where the longs entered for a start and also where the market is consolidating to. Okay, so that's where we are today. This is the situation we find ourselves in, a market that is both in the long term as well as the short term quite aggressively long. All right, now let's go to our next page. So the first thing to then look at is what's the path of least resistance. In other words, there was an old sort of joke we used to make, and we used to say to ourselves, yes, okay, some people might say it's overbought and they want to sell it, and I understand that, okay, but what is the path of least resistance? In other words, what is again, the most likely outcome based on what majority of participants are assuming and expecting? Okay, that's how you sometimes have to look at the market. It's not always about, you could be 100% right, you could be short right now, and this could be the top, and we never see these prices for another 20 years. Okay, you could be right, but what is the path of least resistance? Okay, and this is where you have to really just sort of take your bias out and understand what comes first. Okay, and that's something that's very important in markets. You always need to know what can come first. Well, the most likely path of least resistance is to the upside, not because I say so, but because of market consensus. Okay, and market consensus right now is favoring prices to the upside. Okay, now the difference between consolidation and absorption I'll show you when we get onto the 60-minute, but in essence it's where we have high volume. So in essence this area here is all very high volume, and now we're following a sort of a little bit of a lower volume type consolidation. In other words, the positioning is in with the high volume and the initiative, and now we're seeing lower relative volume as we start to see consolidation. Okay, now in a consolidation phase, obviously we've got a lot of short-term time frames playing out. Okay, sometimes we have buyers down below, sometimes we have sellers, sometimes we have buyers up here, sometimes we have sellers. Okay, and that's what's creating all this two-way trade. But the net to net, if we drew sort of a 5-day moving average, it'll look something like that. Okay, the net to net is prices unchanged over the last 2 weeks. Okay, so markets are consolidating in a relatively tight range. Now, risk reward, and this is where you have to start to think. Okay, in terms of positioning, because the market is very, very long. Okay, what that already tells you, and this is where flags can be a little bit deceiving, right? The older days of, well, there's a flag, and then what you do is you just buy it, and then it goes that flagpole distance the upside. Okay, that's a little bit of hogwash. And the reason has got to do with risk reward. In other words, if buyers are positioned here and here, and this is a consolidatory phase, it's going to require something fundamental to give us that substantial reward to the upside. And that's important to understand, because you're going to be taking on relative risk for the reward you want to receive. Okay, so you've always got to almost understand and what your expectations are. I could understand people saying, well, you should have an equivalent move to what we had this. Right? But factually that's not correct. If you go look at a number of these types of breakout consolidation phases, very often you actually don't get all that much reward. Why? It's got to do with what's come before. In other words, we've already seen the positioning here. In order to get this kind of move to the upside, you're going to need something significant to occur, something fundamental, something that says, okay, well, let's go another 4 or 5%. Okay, think about that. What's going to make the DAX 30 go another 4 or 5%? Right, it's not just going to be technical, it's going to require something quite significant. Okay, if the market was positioned net short in the long term and we were breaking key levels, I'd say, yeah, fair enough, there could be a 3, 4, 5% move. Right, but right now, given where the markets are, given what the fundamentals are, they seemingly are fully priced. So to expect that sort of an upside move, right, you've just got to adjust those risk-reward expectations. Right, timing, and we're going to go through this in a minute, but in essence what we're talking about in terms of timing is how can we time that break, look for the opportunity, and then equally look for and equally look for potential reversal type opportunity. Okay, and then short-term positioning, we've gone through that, and then lastly, how do we remain objective? And this is the real key, and this is why, for me, I really like the footprint chart, because it allows me to be objective. As much as I think we're probably going to extend here and then roll back over very aggressively, right? It doesn't pay to have that view. It doesn't pay for me to have that synopsis and that understanding. Okay, what pays is that when the market tells me the objective facts, I look for the buy opportunity, I look for the breakout, and I assess the information as it's coming in. I stay long so long as the market says I must stay long. And the moment the market fails and the long-term shorts, or you get a lot of shorts entering on that break but price can't move up, then I can enter shorts, because the objective information has told me that actually the buyers are struggling and they're now about to be overwhelmed. Okay, and that's the real art. If you want to learn to be a good trader, get away from distinguishing patterns as almost a a thing that just happens. It doesn't. Okay, they happen for very specific reasons all of the time, not just sometimes, all of the time. And you've got to be able to assess those objective facts. So let's get that chart up. All right, what you're looking at here is a 60-minute. Okay, so M60. Now, where I want to draw your attention to is what's happening in this consolidation phase. So if I scrunch this up, let's look at the relative volumes on the up move versus the sideways. Okay, so we can see on that up move, day one, notice the volume. Okay, that was this day here. That's where we had our peak volume. Okay, so market got long. Right, we then had sort of again a secondary day of long, so a little bit of a lower high in terms of volume. And ever since we peaked, which is this day here, so we can see we peaked on relatively high volume, we can see now that the peaks have started to drop off. Okay, so where are these peaks coming? And that's the first thing to interpret. Right, we've still got peaks. Now the first thing to understand is where are these peaks happening? Right, let's look at these two peaks. Let me zoom this out a little bit. Right, notice how the peaks are happening on a flush down, on a flush down, on a flush down. Okay, so straight away this is a very, very important clue, because what's happening in this market is that we are getting sellers. Okay, we are getting shorts that are positioning. But what's price doing when they flush down? Okay, price is ultimately going in the opposite direction. Okay, so right now it's almost non-committal. Right, what we're seeing is anyone that's long is being flushed out, hence the volume is increasing. Right, but the moment those longs are flushed out, the market then starts to navigate higher. Okay, and this is typical in a consolidation phase. What it does is it's getting everyone long at the high. We can see this. So the first time we went up on the 11th, okay, on the 7th of November, we can see an extreme amount of volume. Everyone went long looking for that continuation. Market started to drift. Eventually flushes down, gets all the longs out, and then the market starts to grind higher and higher and higher. Okay, we can see again, notice how maximum volume was made at the high. Everyone's getting long, looking for that punchy break, and all of a sudden, bang, sellers enter and get flushed out. Okay, they flush out the longs, and that's what's happening here. We have people entering aggressively on the long. It's not going anywhere. They're getting flushed out. We then have people entering on the shorts. It's not going anywhere, and they're getting flushed out. Typical consolidation. Now, those people are selling low and buying high rather than buying low and selling high. Okay, and that's what's creating this two-way trade. So straight away, if I told you that is what's happening, in other words, what's occurring is every time we go down, sellers are entering aggressively and they're getting washed out. And equally, every time we go up, buyers are getting aggressive and they're getting washed out. What do you need to see to confirm that the timing is now that we're going to have this trade? And that's the clue. Okay. So what we need to see is we actually need to see when the market comes up to these higher prices, we need to see the market sustain these higher prices. Okay, notice the number of wicks. 1, 2, 3, 4 wicks. Every time we get anywhere close to this 132.98, we get a sell wick. Same with the buy. Every time we come to this 131.31, we get a buy wick. So what do we need? Well, all we need is we need a 60-minute close either below 131.31 or above 132.98. Okay, that then confirms the break. That then confirms that we're up here now. The sellers are no longer holding this market as resistance. Okay, and the path of least resistance to the upside. Okay, so that's the first clue. What we're looking for. We're looking for sustained bid or sustained offer through those two key levels. Until then, we're just going to keep moving sideways. Okay, there's no point in preempting because you can see what's happening when we do preempt. Now, a breakout's a two-pronged approach. Like I said to you, right, there's a great deal of skepticism. Okay, in my mind, to see a 4-5% up move is going to be very, very difficult. Okay, so the moment we break, what I'm interested in is I'm interested in seeing what this delta does. I want to see positive delta through the upside or negative delta through the downside. Okay, once that's in, it confirms that those positionings are now being held. Okay, and that's a clue as well, because if we get through this 98 and we see a confirmed 60-minute close and we see a positive delta, that tells me that we now see buyers holding on to higher prices. In other words, as I showed you on the poll, the positioning was long from way below. Okay, so we had positioning once, we had positioning twice, and now we have a consolidation phase. Okay, the moment I see that confirmed close above those 98s and I see positive delta, it tells me now the positioning is even higher. In other words, short-term positions are being even more aggressive. Okay, and that's important because that means that in the near term prices will likely move higher, but the moment those positions come underwater, the moment they start to offer, right, we've got a fantastic opportunity to short from 132.98s, not just down to 131.31, but even for the break of that. Okay, do the basic math, minimum 160 tick winner. Okay, so if we don't get it right on the breakout, if we don't make much money on the break, and it is difficult, and it does feel like, damn it, I've lost a little bit of being long, going with the flow, that's okay, because guess what? You're going to make it back and some on the flush back down. Why? Not because Brannigan says so, not because, the pattern says so, but because there are short-term positions now very aggressively positioned if we get a confirmed close above 132.98 and we get a positive delta above that close. Okay. That's it, guys. It's not a complicated process. I think sometimes traders make things very, very difficult. Oh, I think it's bearish because, I think it's bullish because. Okay, it's got nothing to do with that. Okay, what it's got to do with is, what is the price action? What is the timing? How do I execute these things? Now, I just want to take you through two examples. I want to take you through the 12th of November. And I want to take you through the 18th of November. I just want to show you what's happening on the footprint so you can see it. So we're going to go to the 12th of November for a start. Okay, and this is where we came up to that key level. So I can show you what's happening on the delta. Notice the volume for a start. Okay, we're looking at these orange levels. Look at what happens on the volume. So we have the volume escalating. Okay, and we have relatively good delta. So really good buy-side delta comes into that high. Okay, good volume again, positive delta. What does price do? Goes the opposite way. A little bit of delta divergence. Market starts to drift lower. Okay. Now remember, if this is where the positioning took place, we know it's the positioning because of the volume and the delta. Let's see what happens once we take out this level to the downside. Okay. Market comes up a second time. Right. Again, really good volumes. Okay. What's happening to the delta? It's becoming negative. Okay, so we're not seeing buyers lifting aggressive offers. If anything, we're seeing sellers hit into the bid. Okay, eventually those sellers take over, market flushes out, and let's see what happens once we get below those 49s. Okay, market comes in, tests below, goes bid, opens below, and flushes down. Okay, in other words, whenever there's positioning in the market, the moment it gets below that positioning, it washes those positions out. Okay, let's fast forward to the 18th. Okay, this was yesterday, Monday the 18th. Let's see what happens on the 131.31s. Okay, market gets aggressive. Let's quickly just fast forward this. Okay, so we can see market gets aggressive. So we can see the positioning comes in. All right, there's a little bit of a comment, 5,289. Market comes in. Okay. Tests in below those 31, straight away gets rejected. Okay, very quick reversal. Comes in a second time. What do we see? 4,000 volume, negative 200. So highest delta of the day, really good volume of the day. That's where the positioning is. Market starts to go bid, comes back, tests that positioning, goes a second time, comes back. What does it do? Bang. Initiates above it. Look at the volume, look at the delta. Suddenly anyone short there, 131.66 stops out. Market rotates higher. Okay, that's a 60 tick move to the upside. Right, so every time there is positioning, okay, that is your positioning there, that is your positioning there. But what's happening is those positions are not holding on and they're stopping out the moment they get overwhelmed. Okay, that's what you're looking for, guys. You're looking for this build up of positioning, looking for that break. If it breaks and holds, it's going to continue. For now, it hasn't done so. Okay, go look at the 11th of November, the 12th of November, the 18th of November. It's the same thing. Rinse, repeat, rinse, repeat, rinse, repeat. Okay, guys, that's in a wrap.